for an analysis report that makes a really aggressive contrarian case for OKLO. The core claim is that Wall Street is just wrong, missing a massive AI infrastructure play here, and that the recent price drop is a major buy signal.
Right.
So let's just dive right in, because the analysis itself is powerful, but the way it's structured feels like it might be working against itself a little.
I think that's the perfect place to start.
You have this huge multi-year thesis, right? OKLO as the key to survival for AI data centers, with this 2026 catalyst on the horizon. It's a big foundational argument.
A very compelling one.
But then it's immediately followed by these incredibly specific short-term trading signals. We're talking precise Fibonacci levels, a $5 risk to make 50. And I get it. You want to marry the big idea with the timing, but it almost feels like it's for two different people.
That juxtaposition is the exact friction point. The analysis report currently conflates a multi-year investment narrative with a weekly trading call, which risks diluting the report's overarching significance.
Okay, so it's a dilution issue.
It is. The weakness here is that the aggressive specificity in the technical analysis section, the immediate resistance at 85.26, the precise stop loss at 77.50, it clashes both stylistically and functionally with this grand blue sky fundamental target of $150 plus.
It's a different language.
It's a completely different language. You're talking to a long-term analyst and a swing trader in the same breath. And when you do that, the real gem of the analysis, the why Wall Street is wrong part, it just gets buried under all that short-term chart noise.
I can definitely see that. A reader could see that tight stop loss and think, oh, this is a fragile trade, and completely miss a point about weathering volatility for the long-term gain. So are we saying they need to pick one?
Not necessarily pick an audience, but absolutely pick a priority. The conviction is the survival for AI narrative, right? That has to be the foundation. So my suggestion is to clearly segment the analysis report structure. Let the macro thesis stand on its own.
And the technicals?
Use the technical analysis purely as context for the entry point, not as the main driver of the value proposition. The TA should be a tool for timing the thesis, not the thesis itself.
That makes a lot of sense. The fundamentals tell you what to buy, the technicals just help with when. So how do you actually do that in the report without losing the technical context, which is pretty compelling?
I think it's about physical separation and a shift in language. So one concrete way is to restructure that technical analysis and key levels section completely. You could relegate all the hyper-specifics, the $100 target, the stop-loss zones, to an appendix or maybe an auxiliary section.
Something like a tactical entry guide?
Exactly. Technical context for a long-term entry, something like that. And then, crucially, in the main body of the report, you shift the language. You move away from prescriptive trading advice. No more, we need to break and close above this.
And instead?
Instead, you adopt a high-level valuation perspective. You frame it differently. You emphasize that the recent drop to that $77 golden pocket offers a historically discounted entry point for the long-term thesis. It's an opportunity, not just a trade setup.
Ah, that's a much more sophisticated framing. It turns the technical signal into a fundamental opportunity. I like that. So let's drill down into that fundamental claim, because it's really the most interesting part of this whole thing. The central idea is that Wall Street is fundamentally mispricing OKLO. The argument is that the market sees a boring utility company when it's really a critical piece of AI infrastructure.
And that is absolutely the strongest, most innovative argument in the entire report. But the problem is, its power is currently asserted, not proven. The report's most innovative point, this distinction between a utility valuation and an AI infrastructure valuation, is asserted but not sufficiently quantified, which weakens its logical foundation.
Right. If you're going to make a claim that bold, you need the numbers to back it up, especially for a skeptical audience.
Exactly. And the weakness is sort of twofold. First, the analysis makes a great qualitative case for the massive power demand from hyperscalers, Google, Amazon, and so on. But it doesn't give you the quantitative metrics to show the sheer scale of the problem.
You need to show why the grid can't handle it.
Yes, why the existing infrastructure simply cannot meet this demand. And second, it doesn't quantify the valuation disconnect itself. The $150 target feels more like a narrative goal than a calculated one, because there's no math showing how you get there by switching valuation models.
So the Wall Street mistake is a fantastic hook, but it's missing the mathematical punch to make it truly undeniable. So how do we ground this? How do we give it that ballast?
The suggestion is to bolster that Wall Street mistake section by introducing very specific contrasting data points.
You need data that proves both the valuation gap and the absolute criticality of the solution that OKLO offers. This is what turns a compelling opinion into a definitive financial argument.
Okay, that sounds like a bit of a heavy lift, but I agree it's essential for credibility. What would that look like? Can you give some examples of the data points needed?
I think 2 key additions would do it. First, you have to quantify the power crisis. Go out and estimate the total power demand trajectory for a few of the big AI hyperscalers over the next 5 years.
Okay.
Then, you juxtapose that number with the known bottlenecks in the current grid. Show how long it takes to build a traditional power plant. This immediately proves that OKLO isn't just selling electricity, they're selling a critical, time-sensitive infrastructure solution. The crisis itself becomes the proof point for a premium valuation.
That really makes the urgency tangible. It justifies why it's not just another utility.
And the second point is just as crucial for the price target. You have to provide context for the alternative valuation. You can do this pretty simply. Briefly reference the typical valuation multiples, EV to sales, maybe PE for established, high-growth AI infrastructure companies.
And compare that to utilities.
And contrast those directly with the multiples for regulated utilities. And you have to explain why they're different. Utility multiples are low because their growth is capped and regulated. AI infrastructure multiples are high because the market expects exponential, unregulated growth. Showing that gap provides a mathematical anchor for your $150 target.
That's it. That's the key. It moves the argument from just saying Wall Street is wrong to proving Wall Street is using the wrong model. It makes the whole thing feel earned.
Exactly.
Okay, so let's shift gears to the final point, the packaging. The tone and style. This analysis is undeniably high energy. You've got phrases like aggressive buy, loading the boat, even smash the like button. Now that's exciting, but we have to ask what impact that has on credibility, especially with a more sophisticated reader.
The enthusiasm is great, and you need conviction for a contrarian call. But the tone here, it risks crossing a line from confident into something that feels, well, a bit dismissive. The use of overly aggressive, fear of missing out language risks sounding dismissive of legitimate concerns, and that ultimately undermines the report's professional credibility.
But isn't that part of the point? To be contrarian, to be aggressive, to cut through the noise of all the boring financial reports out there. Aren't we risking watering it down by making it too measured?
That's the tightrope you have to walk. But confidence has to be rooted in the rigor of the analysis, not just the volume of the language. The weakness here is that the FOMO-style language, things like the drop is done, the weak hands are out, it completely minimizes the severity of the pre-revenue risk, which the report itself correctly identifies as the main bear case.
That's a very good point.
Any serious investor knows that pre-revenue risk in a capital-intensive industry is a massive hurdle. You have uncertain timelines, financing needs, regulatory cycles. And by just glossing over that with hyperbole, the analysis risks alienating the very readers who need a sober assessment of that risk versus the reward.
So it's about acknowledging the gravity of the risk before you explain why you think it's worth taking. It's a trust-building exercise.
That's it exactly. So my suggestion is to adopt a more confident, measured, contrarian tone. Acknowledge the gravity of the pre-revenue status, and then systematically demonstrate why the long-term conviction justifies taking on that risk. That actually increases the report's rhetorical impact on skeptical analysts. You want them to think you're smart, not just loud.
Okay, so how do we translate that into actual edits? What are some examples of shifting that tone without losing the energy?
It's about replacing those emotionally charged phrases with objective, analytical statements that reflect the maturity of the research. So, for instance, that final line, I am loading the boat at $83. It's punchy, but it's purely prescriptive and emotional.
Right.
Instead, you could use language that communicates the same conviction without telling people what to do. Something like, this conviction in the fundamental transition suggests $83 represents a historically compelling entry point relative to our projected AI infrastructure valuation.
That is so much stronger. It ties the action directly back to the thesis.
Precisely. And you do the same with the closing language. Change the let's get this money type phrases to a summary statement that reinforces that core thesis, why Wall Street is wrong about OKLO. That calibration makes the conviction feel intellectual and data-driven, not just speculative.
A powerful shift. It leaves the reader feeling convinced,